been sold the idea that financial independence is all about some number on your account statement, or even worse, that you don't qualify because of where you started out. That's just not true. It's not about some well-kept secret of the wealthy. It's about finding the right information and knowing how to apply it. On the Get Ready for the Future show, we're answering your questions so you can start making real financial change today. The journey to true financial independence begins right here, and it starts with you.
Hey, welcome to the program again, the Get Ready for the Future show, coming to you from the 6th floor of 3 Financial Center in West Little Rock. We are happy to have you along. My name is Scott Inman, and along with me, GenWealth co-founder John Shrewsbury.
Hello.
Good to see you, sir.
Good to see you.
We're going to break from our regular format for just a little while today. We've got a special show today.
Yeah, you know, the economy's kind of going through some gyrations, I would call it, because of tariffs and first one thing then the other. A lot of change going on in Washington. And anytime the economy sees uncertainty, then you can expect volatility in the markets. And so we wanted to be sure that we addressed this because we know that we preach all the time about long-term investing, but we also know that when things like this happen, the media's in your ear about how bad the stock market is and how volatile it is and how people are losing billions of dollars and all of this type of thing. So we wanted to bring some clarity and some calm to this and get focused on what the facts are as opposed to the hype.
Yeah, the truth is often a lot more boring, right?
Yep.
But the truth is what you need to adhere to, especially in times like this. And this coincides, it is totally coincidental, with our introduction of a new member of the GenWealth team. We're excited to introduce Andrew Beatty. He is joining us as GenWealth's Chief Investment Officer. Been in the works for quite some time now, and Andrew comes to us with an extensive background in investment management, and he's here to help our investment committee at GenWealth provide excellence in our research and application of investment choices for our clients. And we're bringing Andrew into the show today. He's jumping right in the fray and joining us on the Get Ready for the Future show to talk about all of this that John was mentioning. Andrew, welcome to the show and welcome to GenWealth.
Yeah, thanks, guys. I'm happy to be here. You're saying exactly right. I'm jumping right into the fire with this market that we're in right now.
Yeah, unfortunately, nothing to talk about, right, on this first interview.
That's exactly right.
You know, when you think about 2025, Andrew, and where we are on a year-to-date perspective as we dive into this talk, you know, the volatility has certainly returned. I read today that we've now had the most significant pullback since we had in the fall of 2023. I think the big difference is this time is last time we had a pullback like this, it took 3 months, and this time it's occurred over 3 weeks. And when you think about what's caused it, you know, you've had the backdrop of tariffs, you've had the cuts in government, and even the different way of approaching the war in Ukraine. When you think about all of that and pack it all in and create a message to investors, what is your message in the midst of all this volatility?
Yeah, I think you bring up some really good points there. There are a lot of different cross currents that we're seeing right now, whether it's tariffs, as you mentioned, cuts in government, the war in Ukraine, et cetera. And what we're seeing is volatility. It's uncertainty in the market. And so, yes, to call the beginning of this year volatile, it's probably an understatement. And I think that, to your point, it's less the severity of the drawdown and more of the speed that has gotten a lot of people's attention. So in fact, over the last week, we've actually seen the U.S. markets decline to the point where, as of Tuesday's close of this week, the S&P was down a little over 5% so far in 2025. That is a dramatic difference from what we've seen the last couple of years, where, frankly, investors have kind of gotten used to seeing just everything move up. So part of that is just being conditioned to expect a lack of volatility. And so right now, when we do see volatility, that's causing some concerns, and rightfully so. I mean, people are going to watch the news, they're going to see the headlines. What we want to make sure that we're doing is understanding the data, understanding what's leading to this volatility so that we can react accordingly and not, you know, leaping out into the deep end without really evaluating what's going on. So I think the first thing we want to bring up is that when we were looking at 2025 coming into this year, we did think there would be a slowdown in the economy. We did think there was going to be some volatility, and more policy-driven volatility in particular. What we didn't expect, I think, and I know we're going to touch on tariffs in just a minute, but we didn't expect how quickly and how much the new administration would lean into those tariffs. So that's caught the market by surprise, caught investors by surprise a little bit. And what that does is it makes it really uncertain and very difficult for economists to forecast growth, for analysts to forecast corporate profits, for companies in general to forecast what they're going to do with spending. So with all of that uncertainty, that's what we're seeing right now. That uncertainty is leading to volatility. And look, we do expect volatility is probably going to persist. What everyone's looking for right now and what we are looking for is visibility. And right now, unfortunately, things are just a little cloudy.
Yeah, I would compare this to like a send the house blitz in college football from the defense of what the president is doing as far as just his whole game plan. And I think that creates some of that uncertainty because of the speed at which he and his administration are moving through this. But let's talk about these tariffs, because there's a lot of debate out there, as you well know, Andrew, that tariffs are inherently inflationary.
Yeah.
Is that really the case, or is it going to be maybe a period of time of inflation, but that working itself out? I know that inflation as measured by the Consumer Price Index today just came out at like 2.8%, I believe the number was.
Right.
Yeah, look, I would love to say that I have some special insight into what's coming out of the Oval Office and whether there is a broader strategy at play here. I'm not sure, and I don't think a lot of people do. So, whether there's a coherent plan from the Trump administration, like I said, I'm not sure. But to your point, I think what we've seen is this administration really lean into the tariffs. And what that's done is kind of surprised people, because if we look back to Trump's first term, and we want to use that as kind of an analog to what we would expect going into the second term, tariffs were often used in that period as a negotiating tactic. The administration would delay, they would reduce, they would even remove tariffs, especially when the stock market expressed any sort of disapproval with the move. Those olive branches that the White House would extend would then kind of spark a stock rebound. This new administration, the new version of Trump 2.0, I guess if we want to call it that, has seemed more committed to these tariffs. So, the question is, what does that mean? And is it truly inflationary? And economists disagree on this. I think everyone disagrees. And the reason is, frankly, we don't know how they're going to be implemented. We don't know where they're going to be challenged. We don't know what the comment period that happens within the U.S. Trade Representative's office will produce. And also, we don't know what the other countries will impose as reciprocal tariffs, or if they will at all. So if we assume that they're inflationary, and I'm not saying that we should, it's likely to be an immediate but not ongoing inflationary increase. That is what most economists have seen right now. It's an adjustment period. That's what the administration has said. It's an adjustment period, but there's not going to be this full tilt, ongoing tailwind for inflation as we keep going. Now, again, that all depends on whether things are delayed, and we've already seen tariffs for Mexico and Canada be implemented and then pulled back, implemented again, and then reduced. So like I said, it's really difficult for economists to compare and to understand which way things are going to go when there is that uncertainty. And I know everyone's going to get tired of hearing me say uncertainty, but that's what kind of the market that we're existing in right now. One of the things I would say is that when we're thinking about corporations and corporate spending, there is expected to be a lot of investments in artificial intelligence in 2025. The other thing is that markets came into 2025 expecting changing regulations, loosening regulations, however you want to phrase that, that would spur additional business investment. The problem we have right now is that this uncertainty regarding the tariffs has thrown a wrench into that plan for right now. Again, we need a little bit of near-term visibility. We need some, just clearly for these clouds to part ways so that we can understand what to expect. The other thing that could impact this and could lead to some issues in the economy is if we have some near-term inflation uncertainty, which we've already discussed, we also have what's called a potential negative wealth effect. And that is that if stocks go down, typically consumers begin to spend less. less. So if that happens, the economy may slow more than we originally anticipated. And remember, we did anticipate that the economy would slow this year, not recessionary, but a slowing of the economy. So there are a lot of cross currents here, whether the tariffs are inflationary, whether there's a broader plan, whether the economy is going to slow or advance. There's just a lot of uncertainty right now. So again, what we want to do is make sure that we are focused on the data that we have and making a rational decision about how to address the markets.
We're talking with Andrew Beatty. He is GenWealth's new Chief Investment Officer here on the Get Ready for the Future show. And Andrew, one of the things we talk about with our clients all the time, and I understand that we measure market performance often by using the S&P 500, but we often tell our clients the S&P 500 is not the market. So when you take a look at the backdrop of everything that we've been talking about so far, how does that affect or color our approach to investment selection?
Yeah, it's a really great question, and one that frankly we've all received a lot recently. One of the first things that we want to tell people is, look, volatility is normal and don't panic. This is somewhat to be expected. The way that we like to phrase it is, this is a toll. This volatility is a toll that investors have to pay on the road to attractive long-term returns. So the stock market, has historically corrected, and by corrected, I mean that's a drop of between 10 and 19% about once a year. But the market has still achieved about a 13% annualized return, including dividends, since 1980. So we have a long period of time where we do expect, and we have seen pullbacks in the market in a given year, and we've still produced a 13% return. I think anybody would probably take that. The other way to think about this is, and a lot of investors say, okay, I want to pull my money out. I want to go to cash. I want to not be invested right now. I want to try to time this. The way to think about that is that if you miss the best day of the year in the stock market, and those typically happen during the most volatile periods when stocks often are in a correction, your annualized return, instead of being 13% since 1980, takes almost a 4% hit. So now you're down below 10%. Now let's assume if you miss the two best days of the year, again, those tend to happen during stock market corrections, that hits nearly 7%. So now you're looking at mid-single digits returns, and that's simply because historically, investors just aren't that good at timing the market. So the way that we want to think about investing during this current environment is a couple of things. One, we want to remain invested. That's the way we're going to win over the longer term. The second thing is we want to remain diversified. And diversification is the key here, because if we had only been in U.S. stocks, we would have taken every bit of the downturn at the beginning of this year, while international markets, emerging markets, were actually outperforming and were advancing. So as we diversify, not just in stocks across geographies, but with stocks, with bonds, with other allocations to other asset classes, that's how we can somewhat and hopefully try to insulate our portfolios from this volatility. With all of that being said, and I know we've talked a lot about uncertainty here, there is some relatively good news. So the fundamental underpinnings of this economy and of consumer conditions remain relatively sound in the U.S. We're going to continue to get more data. We're going to, again, let that data, rather than these sensational headlines, et cetera, lead our investment process and maintain that diversification as we go through and build portfolios.
Andrew, let's kind of draw back and talk a little bit about the investment process that you and the investment team here at GenWealth are shaping. The investment team at GenWealth, as you see two of them on the screen here, myself and Scott, Tim Key and Charlie Skinner, all work together with Andrew to shape this investment process. What are the things that we're doing sort of behind the scenes to not only make a better process for GenWealth, but also to be sure that our clients get through a period of volatility with the right information?
Yeah, and I think that's the key there, is the process. And one of the things that we want to stress here is that the process that all of your clients have gotten used to, the ready to retire process and how you build portfolios, isn't changing. We're just enhancing that to make it a bit more what we would call institutional. Let's bring the approach that the largest and most sophisticated financial institutions in the world and how they operate within their business, let's bring that to GenWealth. And so that's what we've done. Again, we have an investment committee, and what we are doing is on at least a monthly basis, and more frequently than that during the volatility, we are meeting to go through returns, to go through both fundamental and technical data to look at the individual markets, to look at individual portfolios and the positions in those portfolios to make sure, again, that even though the volatility is occurring in the marketplace, that what we are doing is sticking to our rational process. We don't want to let, again, these market headlines, this volatility, have us make decisions that are not based in reality and not based in the data and the rational approach that we want to take. So that's what we're doing in this somewhat, again, we're trying to make sure that the same approach we take when the markets are up 10% is the one that we're taking when the markets are down 5%, because that's the way we're going to, again, limit that volatility, hopefully, and try to smooth that ride to make sure, again, we're not running out of money at the end of the day. So that's the goal here. Again, we're trying to institutionalize this. We're trying to make it a rational approach and bringing all of the expertise that GenWealth has to bear for our clients.
Well, Andrew, you mentioned the ready to retire process, and of course that's our key thing that we plan for from a retirement perspective, is to make sure that our clients have the retirement income they need and that they want, and that their assets will support that for the rest of their lifetime. But one of the exciting things we've been talking about as we brought you on board is the ability to bring some customized investment solutions to some of our clients and some of our future clients who have the retirement income piece. The box is checked, right? That's satisfied with a portion of their assets, but they have these outside investments or additional money that they want to manage outside of that retirement income. Talk about what we're building there.
Yeah, it's a really exciting thing for us as we're building this out. And what we want to stress is that, look, some of these investments aren't for everyone. They clearly are not. There are additional risks that we have to monitor. There are additional steps that we need to go through in the due diligence process to make sure that these are appropriate vehicles for our investors and for our clients. But the reality is that there are a host of different options out there for investments that we can take advantage of. And so we are looking at things like alternatives, at real estate, at infrastructure, at private equity, venture cap, et cetera, where we can build those custom portfolios for clients that have that additional money and they want to either, there's various ways to do this. We can be more aggressive with some of those assets. We can also look for ways to effectively limit the volatility. So we can invest in things that are uncorrelated or don't really track the stock and bond markets. So, there are a lot of different ways that we can do that. Now, the key there, and the key word that you mentioned, is custom. Like I said, it's not built for everyone. All of these investment vehicles are not for every investor out there, depending on their risk tolerance, their time horizon, their income needs, et cetera. So what we are doing is evaluating those client needs and their wants, and again, their risk tolerances, et cetera, to then build those customized for them on a one-off basis, so they are getting an approach that is unlike the person down the street and unlike probably what another advisor could offer them.
Well, it's certainly exciting as we look towards the future and begin the partnership with you. And I know you got to get back to work, so we're gonna let you go and leave it there for now. But you'll be joining us, I'm sure, in some upcoming Get Ready for the Future show programs. But Andrew, thanks again. Thanks for taking a little time out of your day for joining us today.
Absolutely, guys. Thanks, and thanks for having me on today.
Good to see you, Andrew. Thank you. All right, let's. Why don't we go back to our regular format,
regularly scheduled programming.
Regular scheduled programming while we've got a little bit of time. But I do want to just jump back to Andrew's point for just a second and emphasize, I did this in real time the other day when a client called and was concerned about the market and what have you. I looked at where he was today versus where he was in actually October. Yeah. And it's basically the same spot. So when you draw back from this and look at this in the grand scheme of things, yes, it does sound very volatile right now and lots of change in Washington and basically a change in the way the country is handling its finances. But I think that there is a a need there for something to happen because the road we were on was unsustainable, and there may be some pain, but I think it could be a situation where we come out on the other side actually more healthy in the economy and in the country as a whole.
Yeah, and a couple of takeaways for me, the stay invested piece, when he talked about missing the 2 best days per year since 1990 and how damaging that could be to your overall return. I think that's key to remember. We're not going to be able to time the market. We don't know when the bottom's going to be. Staying invested, we get some of our best performances when the market is near or at the bottom. So you don't know when those are going to be. So bailing out now is not a good tactic. And then the other piece was the diversified portfolio. When you look at that, because you were talking to a client running it since October, I've had a couple of conversations where I ran just a year-to-date report on our client's diversified portfolio. And when you look at indexes down 4.5, the S&P year-to-date, 9 on the NASDAQ, and then you look at a diversified portfolio that's down 1.5 maybe since the beginning of the year, and that's certainly just an example, not indicative of everyone's returns, but it is an example of the diversified portfolio and how really it shines, John, when the market's down. You know, sometimes you get frustrated with it when the market's up because the market can be soaring and your diversified portfolio is just plugging along, but it shines when the market's down.
The bond market actually is positive this year, and when you have this approach that we have with the ready-to-retire process, that's what happens, is that the bond market tends to offset some of the negatives of the stock market during volatile times, and we're seeing that play out right now.
Hey, and if you've got concerns about retirement or you just want to learn more about it, you want to invite you to a free educational workshop we've got coming up. It's called What You Need to Know Before You Retire. We're going to be talking about investments in the economy. We're going to take your questions, but we're also going to be talking about taxes, Social Security, Medicare, things you need to know about before you plan to retire. Come join us on Tuesday, April 8th at 6:30 at the Chenal event venue in Little Rock. You can visit getreadyforthefuture.com/academy to sign up. Again, it's free, but space is limited. It's coming up April 8th, so to reserve your seat, just go there and register. We do have time before the end of the show today to hit a couple of questions. So we'll start with Tony from Little Rock. If my spouse remarries after my passing, how can I ensure my assets ultimately go to my children? Tony, estate planning key here, so that's the focus of this question, and it is a concern, and I can tell you from personal experience, my spouse actually did pass away about 5 years ago, and I have remarried. So those are things that I've had to go through personally with my estate and with my assets, and I think in general, we certainly want to start by saying get a counsel from an estate planning attorney. We are not attorneys here, but we can cover some of the basics of just how things work when it comes to transferring assets at one's death. And John, when you start with this discussion, you know, he may be thinking about his trust, right? Does he need to rewrite his trust? Does he need to start a new trust? And those are really good questions to consider. But the first piece of this is there are certainly things that you can do just from a beneficiary perspective that can make sure that your assets go to your children.
Yeah, let's kind of go to school on this for just a second. A beneficiary designation on an account trumps anything that you do in terms of a will or a trust. So if you beneficiarize assets to your now new spouse and don't do anything else, then that becomes the property of the new spouse. And it is 100% up to them what they do. So there's no requirement for that to pass on to your kids in this kind of scenario. So what you have to do here is you have to think about how you designate things inside a trust. And this is an issue for blended families. Oftentimes they need a trust to be able to affect this. So what you would do is you could actually structure the trust to say that the surviving spouse could have use and control of those assets while they are alive, but at their passing, those assets have to go to your kids. That's a very common thing that is done in terms of IRA accounts, 401k accounts, those types of things. Now, if you're talking about a non-qualified account, meaning an after-tax account, that can actually be registered as joint tenants with rights of survivorship. And I know I'm using some technical terms here, but that is a way that people can actually jointly hold assets. So you could legally add your children to a joint tenants with rights of survivorship account, and that would pass on to your children as opposed to your spouse. But I think the rub comes in here, Scott, where in either the qualified or the non-qualified setting, you're in a situation where you'd like for your surviving spouse to have use of the funds,
right,
but then you ultimately want to be sure that you don't disinherit your children. And if they have children, that they don't go, well, to heck with your kids, I'm going to give it to my kids.
Yeah.
And I think that's the consideration there. And this is a subject of much discussion every time we sit down with someone to do an estate plan.
Yeah, and I think it's important for Tony to have that conversation now with your spouse so that you can kind of talk about how you want things to be lined out, and then visit with an estate planning attorney and get that lined out in your trust. And then if the trust is funded properly upon both of the spouse's deaths, then all of those instructions are in place, and the trust owns those assets and disperses them or distributes them as the language in the trust dictates. But it is a really good question, and certainly one that needs to be addressed for every family, but especially one that might end up being blended. Thanks for the question, Tony. I want to remind you to subscribe to our YouTube channel for exclusive content you can't find anywhere else to help you discover, protect, and share true financial independence. Find us on YouTube by just searching for GenWealth Financial Advisors. We have a few minutes left on the show, and we're going to get to one more question before we go. TJ from Benton is next. I'm 57 and considering retirement soon, but I own a business. Are there tax-efficient ways to transfer ownership? How can I reduce capital gains or estate taxes in the process? TJ, thanks. Great question there. So we're not talking about selling the business necessarily. He's talking about ways to transfer ownership, and planning for the transfer of ownership of a business while reducing taxes is an important step to when considering retirement. And I know, John, you're going to be the expert out of the two of us on this. You may not be considering retirement. I think we'll probably have to lock you out of the office at some point, but you do have plans in the works of transferring ownership someday.
Yeah, so let's talk about maybe potentially a transfer of ownership to a family member, because I think that may be where this question from TJ is going. So you can think about this from a gifting standpoint. Now, there's some confusion about gifting because a lot of people get hung up on the gift tax exclusion of $17,000 or so per year in 2025. Without triggering a gift tax, you can gift that amount of money to any particular person. Doesn't even have to be a family member if you gift $17,500. Well, you say, well, heck, my business is worth a whole lot more than $17,500. How do I deal with this? Well, there is the lifetime exclusion that is in place, and that actually is a cumulative thing. And I believe that number, Scott, is about $12.9 million in 2025.
Yeah, and that's individual.
Yeah, that's an individual thing. So if you own your business yourself, you can actually gift $12.9 million to someone else, and there is no estate tax that goes on in terms of that gift. So that is a significant way that assets can be transferred through to a family member. There's also what is called a valuation discount. And a valuation discount really is if the business is structured as a family-owned corporation or an LLC, you might be able to take advantage of this type of tactic where you have minority discounts and things of that nature. And I would really encourage you to just use that phrase with a business planning attorney to see what the options are for you in your particular situation. There's also things like an employee stock ownership program. That is where you establish a formal program where you can actually sell shares of the company through an ESOP to members of your team. So keeping it inside the family, so to speak, not necessarily your genetic family, but your family in the business is a way to do that. But let's also address the issue from a sale to a third party outside the business. essentially the only way for you to mitigate capital gain taxes on an outside sale is to do what is called an installment sale. So let's say that your business is worth $5 million as an example. You might sell that in installments or sell that and take installment payments on that particular asset, and you're going to lessen the capital gain tax in any one given year because you're only taxed on what you sell in that year. And so I think, Scott, there are a lot of ways to kind of cut this. And as you said about the whole estate planning thing a little bit earlier, this is where attorneys really earn their worth because they can walk into this situation, and there are so many nuances. And as you kind of alluded to here at GenWealth, we think about how GenWealth will continue to be a generational firm. And I have kids that are working in the firm, and I'm working on that on a constant basis of how this firm transfers in ownership from my shares of GenWealth to shares that would go to my children. And so that is something that we are employing business planning attorneys to do because, number one, it is a very specific field of expertise. But secondly, there's emotions involved in this, and what you want is a very clear-eyed view of the situation. You don't want to just knee-jerk something and decide, hey, this is how we're going to do this. Come heck or high water, I'm just going to do it this way, because you could be in a situation where you're paying a whole lot more in taxes on the gain of that business than you would be otherwise.
Yeah, and I think it all still points back to holistic planning. You know, it's real easy to get micro-focused on how do I avoid or limit, minimize taxes in selling my business, transferring ownership of my business. But the other piece I kind of hone in on, John, here is TJ's 57 and considering retirement. What about retirement income? That is the key piece to this, too. How much are you going to need to live on? Are you going to go do something else? I mean, 57 is kind of young, and usually I think business owners typically don't sit still much after they get out of one venture. They may want to take another one. So how does that fit into the overall plan, too? But establishing an amount in terms of assets that you need to create the retirement income you need and want potentially for the rest of your life or at a future date if you plan to work before you fully retire, if it's a full stop or if it's a partial stop at 57. Those are questions we need answers to, too.
Absolutely. I tend to think about this as a dimmer switch, if you will, as opposed to a light switch. A light switch is either on or off. A dimmer switch, you can fade the lights down or up in whichever direction you're going. Same thing when it comes to working in your business. It may be that you have the opportunity to sell and stay and then slowly fade out of that business over time, still be involved in it. And there's some real positives to that too, because one of the things that you would need to deal with in a installment sale is the viability of that business. Well, if you're still involved in the business, then you can monitor that viability a whole lot better than you can if you're on the lake fishing or something.
Well, our thanks to TJ in Benton for that question. Our thanks to Tony for sending in a question, and our thanks to Andrew Beatty today. Andrew is GenWealth's new Chief Investment Officer, and he joined us for half of the program. If you missed that, you can go back and check it out on YouTube. It's also housed on our Facebook page and on podcast, and we'll be hearing from Andrew again in the future. Time for our final thoughts for today's show, though. John, we'll start with you.
Scott, I want to go back to Andrew's conversation about what's going on in the markets and going on with the volatility in the markets and what have you. And if I can bring anything to this, it's the longevity that I have in the financial industry. I've seen just about everything, all the way from Black Friday or whatever it was back in 1987. I had just begun investing in mutual funds at that time, all the way to the latest downturn that we had with COVID. Seen just about every iteration of things. And what you find is that time generally heals almost every wound that you can get in the stock market. And things that we are greatly concerned about and greatly focused on today are just an afterthought, sometimes 6 months down the road. Do not allow the hype and the commentary to divert you off of your well-structured financial plan. And if you don't have a well-structured financial plan, don't do anything until you get a well-structured financial plan and execute on that plan, because your financial independence really does depend on it.
I'll just piggyback off that. If you'd like to create your financial plan, if you don't have one for retirement, you can walk through the GenWealth Ready to Retire process with us. The first step is to reach out either via phone. You can call us at 866-653-PLAN. That's 866-653-7526. Or just shoot us an email. Send it to show@getreadyforthefuture.com and begin your journey to discover, protect, and share true financial independence. And that's all the time we have for this week's Get Ready for the Future show. Glad to have you for this week's show. Again, thanks to Andrew Beatty, our Chief Investment Officer, for talking markets and tariffs and economy. And if you'd like to get a question in, you can text it or send a voicemail to 501-381-5228. We'll see you next week.
The GenWealth Financial Team is available to you 24/7 at info@getreadyforthefuture.com or call our offices at 866-653-PLAN. That's 866-653-7526. You should personally consult a financial advisor before making any investment, and no strategy can assure success. Securities offered through LPL Financial. Member FINRA SIPC. Investment advice offered through Independent Advisor Alliance. Independent Advisor Alliance and GenWealth Financial Advisors are separate entities from LPL Financial.